Well, thank you for joining today. We'll go ahead and get started. If you have questions along the way, use the Q&A feature on the webinar, and I will try and answer the questions that as they come in, and any questions that I'm not able to answer, we'll follow up with afterward. All right, let's go ahead and get started. So what is tax alpha? If we think about a 9% investment return taxed at the highest capital gains rate, including the net investment income tax, so 23.8% federal tax, it really reduces our after-tax return down to 6.8%. So tax alpha are strategies enhancing after-tax returns by reduction of taxes. That's what I do every day. That's what I love to do, is minimize taxes and increase wealth for people so they can get out there and spend the money how they want to instead of paying it in taxes. For an example of that, let's just think about if an investor at the highest marginal tax bracket wanted to buy a foreign stock that pays an annual $10,000 dividend, what would be the tax implication if they own that in a taxable brokerage account versus owning that in a tax-deferred IRA account or retirement account? So normally when I do this in person, I kind of ask. So if you want to take a guess in your mind, which one would be more beneficial, owning a foreign stock in a taxable brokerage account or a tax-deferred account, think through that, and I'll show you how the math works. So it's actually better to own that stock in a taxable account. You see, you end up with $7,600 after taxes versus $5,000. So doing the math, that's a 25% difference on $10,000 of income just by thinking about which type of account you should own that stock in. So here's how the math works. So foreign stock after a 20% foreign tax dividend, or withholding, like foreign tax withholding of 20%, you're left with $8,000. If this is in your tax deferred account, again, the taxpayer's at the highest rate, so they're paying ordinary income tax on that at 37%, tax of $2,960, net after tax $5,040. If we look at the taxable option, what's changed here? So taxable, we still have our $10,000 dividend. We still have our foreign tax withholding of 20%, the 2,000, so we're left with 8,000. Now we have capital gains rates plus the net investment income tax. So our tax is 2,380. But because this is in a taxable account, we're now eligible for the foreign tax credit. So the United States will give us a deduction or a credit against that tax that we paid at the foreign level so that we're not double taxed. We still have an additional 380 of tax, but our after-tax return or net is 7,620. So I'm going to talk about some strategies, kind of mixing in the wealth management services that we provide at Squire, and giving you some tips as investors and as taxpayers on how you can create tax alpha. And some of these things are simple and we don't always think about them, but they're simple, very easy to implement. Some are more complicated, but we'll jump into some of these other ideas as we go along. Starting out, so in 2025, these are the tax rates for individual income taxpayers. Now, 2025 is the last year of the Tax Cuts and Jobs Act, the TCJA, aka the Trump tax cuts. So these are set to expire. The tax regime we're on right now is set to expire at the end of this year. So we would go back to what it was before. Now, we had an election in November. Trump was reelected. We also have Republican-controlled House and Senate. So if I were a betting person, I would bet that a lot of the things that are in this, maybe all of them, in the Tax Cuts and Jobs Act will get, either extended or made permanent. A lot of ways that can happen, but just to be aware, the way that the law was written, it is set to expire or sunset after this year. So we still have one more year um, of these lower tax rates and more room in kind of the middle zone. So it was a tax cut kind of overall, and a couple other things that may change: the estate tax, which is the tax or the exemption, I should say, which is the amount of an estate that somebody can die with and not have the estate tax kick in, is very high right now. It's set to get cut in high. So when I say very high, it's like around 13 million or something. It would get cut in half if there wasn't an extension passed on that. Capital gains, we still, long-term capital gains, these are the rates for the 0%, the 15%, and the 20%. And then we do still have the net investment income tax, which is an additional 3.8% tax on investment income. So interest, dividends, capital gains, when your income's over these thresholds. And that 3.8% net investment income tax, that was a pre-TCJA, kind of came about during the Obamacare era to help fund Obamacare. All right. So what can we really do? I mean, we can't control the tax rates, the tax regime, the laws that get passed. But really, the things within our control somewhat are managing income tax brackets. That's the name of the game with tax planning. It's getting your dollars taxed as much as possible in the right bracket, in the right year, and matching up the type of income to the right investment vehicle or, strategy that way. We can avoid portfolio taxable capital gains. Asset location, that's an investment term or a strategy that we can use to reduce taxes over time by investing the right assets in the right places. And then we can manage our tax costs during our accumulation phase of life, our blackout phase, which is kind of in between earning time and our retirement time, and then our spend down stage, which is the retirement time after our working years. So we're going to go into each one of these areas and kind of talk about strategies that can be implemented to help reduce taxes over time. Managing our income tax thresholds. So this is key. This is the name of the game for tax planning and tax savings over time. So what we want to do is make sure we're avoiding as much as possible higher effective income tax rates by avoiding higher taxable income and just really monitoring our tax brackets. So if there's room in a lower bracket, it might mean accelerating income. If we're getting close to the top end, or we're going to go over a bracket that we don't think we otherwise would go over, then we may want to try and defer some income. So lots of ways and tricky things you can do to help that. But we just want to know, first off, what tax bracket are we in? What tax bracket are we likely to be in the future and along the way, in several years, and then make decisions and kind of plan around that tax bracket threshold to keep as much of our income taxed at the lower rates as possible. So focus on spreading income and expenses over the next 3 to 5 years instead of only focusing on the current year. So a lot of times when we're doing our tax returns, we're coming up on filing season. We are filing 2024 tax returns. Everything's already happened. So if there's some things we can identify that may save a little bit in taxes, maybe some credits we can take advantage of for things that have already happened. But really, we need to take a more future, longer term approach in order to have any meaningful impact on our future tax situation and how much we pay in taxes in the future. So if you're stuck in the historian, got to file 2024, that certainly has to be done. But the sooner and the more quickly we can look to, all right, what's coming in 2025, what's coming in 2026 and beyond, are there things we can do now to reduce the tax that we pay later? So we want to manage the recognition of tax deferred income in appropriate years. So some examples of some flexibility. These are, we can use retirement accounts, we can use traditional IRAs, annuities, we can use Roth conversions to accelerate income. We can use contributions to these types of accounts as well to defer income or to take advantage of low tax brackets now by filling up Roth buckets and things like that. Moving on, we can manage the payment of our deductions to some extent. So one of the big ones is our charitable giving. Some simple planning around timing and the type or the way we donate to charities can have a huge impact on managing these tax brackets. There's state income taxes that can be prepaid or delayed in some cases, depending on what's needed for the taxpayer. Property taxes, it's a little harder to do that one, but you could prepay essentially if you needed to. As far as charitable planning, some of the strategies we use are donating appreciated assets. So in order to get a tax break there, and how that works is, let's say you invest in some stock, and maybe you buy $1,000 worth of stock. Maybe it's a stock that's done really well. NVIDIA did really well last year. I don't know what the next best stock's going to be this coming year, but let's say you bought NVIDIA over a year ago, and you bought it for $1,000, and now it's worth $3,000. If you were going to donate $3,000 to a charity, you could donate the stock instead, and you could even take your cash and buy that stock right back, and you would reset your basis from the 1,000 to the 3,000, and that unrealized capital gain would disappear. So you would never have to pay taxes on that unrealized gain. So another strategy that we often use is consider bunching deductions. So part of the TCJA was to really increase the standard deduction that taxpayers could pay. So for a married couple, it's almost $30,000 now, and in order to even get any benefit from itemizing your deductions, you'd have to have more than $30,000 in state income taxes paid, real estate taxes paid, and that tax piece is limited to $10,000. And then it's mortgage interest and charitable giving. So if you're, let's just assume you're at the cap for state taxes at $10,000. If your home's paid off, you don't have any mortgage interest, and you're donating maybe $10,000 a year to charity, well, you're only adding up to $20,000, so that's not more than the standard deduction. You're not getting any additional benefit for itemizing. But if you were able to front load your deductions, your charitable giving, maybe you do 3 years worth in 1 year, then that year you would take advantage, and you'd have some benefit for your normal charitable giving. And that's always tough with timing, but there are ways to do it with using appreciated assets, or if you have the cash flow. Another way to do it is using a donor advised fund. If you're concerned about the timing of when the charity receives your donations, you kind of want them to receive it more regularly, you can use a donor advised fund, which is a cool type of account that you get a charitable deduction when you fund it in the year that you fund it, but then you have a giving account that can be given on your time frame and to the charities of your choice, as long as they're the 501c3 charities. And then the QCDs, when you turn age 70 and a half, you can start to use your IRA to make charitable donations, and that's like the donating appreciated stock on steroids. It takes an ordinary income item that would hit your tax return and removes it completely. So you accomplish your charitable intent, and you save taxes along the way. All right. Remember, I'm just checking the Q&A here. We don't have any questions in there yet, so as you have questions, let's get those in the Q&A, and I'll try and answer those at the end. Let's talk about avoiding portfolio capital gains. So you can, what we do at Squire Wealth is use an evidence-based approach. So we're using an asset class investing strategy, And really, the things you can focus on there are tax cost. So, like we talked about, owning the right stocks and the right types of accounts. We can look at fees, transaction costs, bid-ask spreads, and the cost of idle cash or having cash sitting on the sidelines. If you An evidence-based approach is good because it limits trading. See, if you're buying and selling stock regularly, the chances of the tax cost going up goes up significantly because you're triggering a capital gains potentially as you're doing those trades. And so you really want to make sure that your strategy isn't being, any gains you're able to generate aren't being eaten away by taxes, fees, and like cash on the sideline. So we can help there. That's what we do every day at Squire Wealth Advisors, is help clients have a tax efficient investment strategy, and seems to work out pretty well over time. Accumulate portfolio growth in unrealized gains, so which will receive a step up in basis. I'm going to talk a little bit more. I've got some charts that kind of talk about that idea. But anything that's non-retirement related, any investments that are not retirement related, they are eligible for capital gains tax rates if you hold the investments at least a year or more. And then when you pass away, the assets are stepped up to fair market value, so the unrealized gains go away. So, I mean, kind of an example of this, if my grandmother owned some stock and she wanted to give me a gift early, and the only way she could do that was to sell the stock that had, maybe the stock she's owned for a long time, and it has large unrealized gains, so she bought it for a low price. It's now grown over the years, and it's worth quite a bit more than she paid for it. Well, if she sells that while she's living, now the gain, that unrealized gain, becomes realized, and she has to pay capital gains taxes on that. Alternatively, if she can be a little more patient and the receiver can be a little more patient and wait until she passes away, then that stock receives a step up in basis and the unrealized gain vanishes or disappears. So just planning on what we give and when can make a big difference. All right, realized gain only to fund lifestyle or to rebalance. So this kind of goes into the trading aspect. If you take a long-term approach with your investment strategy, then you're able to delay realizing gains. I mean, of course, if you need to use the money to fund your lifestyle, or you do want to rebalance so that your strategy doesn't get too out of whack. But other than that, there's really no need to trigger capital gains just to trigger them. And then loss harvesting when possible. So, and this should be done continually, not just at year end. So a lot of times people will wait till year end to look at their portfolio, what's gone up, what's gone down. Let's sell the ones that have gone down so we can trigger the loss, replace those with something else, and that'll help reduce taxes. Well, the problem with doing it at year end, or one time a year instead of continually, is the market is up and down every day. And last year was up overall. There probably wasn't a lot of losses to harvest, but there's several, oftentimes there are down points in the year where harvesting might make sense. And by the time the year is over, those opportunities are gone because whatever was down has recovered since then. So that should be looked at continually. We look at our accounts that we manage daily. We've got software that helps us track them. And we're analyzing those opportunities when they come and taking advantage of them. And then utilize ETFs. So ETFs stand for exchange traded funds. And in your taxable brokerage accounts, these avoid capital gain distributions. So it's really a no-brainer. They're usually less expensive as well. So it's really a no-brainer to use ETFs for our investing, and as opposed to mutual funds, because mutual funds, as money is coming into the fund and going out of the fund, if other investors in the fund need to take cash out, and the fund has to sell some of the investments inside, which all fund owners own a portion of, that if it triggers capital gain, that capital gain distribution is spread out to all of the owners of the fund, even if you weren't one of the owners who sold. With an ETF, you're buying and selling directly with the market, and so you're only triggering the capital gain on your activity, not on the other investors or the fund activity. So, and ETFs have become more popular. There's lots of great options there to utilize those. All right, let's talk about asset location. So this is a really kind of a simple concept, but it's a concept that not very many investors take advantage of, and even a lot of financial planners are not aware of this simple concept. And really, it comes down to that initial example of our foreign stock that paid the $10,000 dividend. If we just take a minute and think strategically about where our investments should be within our types of accounts, so most of us, depending on your situation, you might have taxable money in a taxable brokerage account. You might have tax deferred money. That's money that you've been saving for retirement. You've been getting some tax deductions for it along the way. This might be 401k money as you were working, that type of tax deferred money. And then there's Roth. Roth is the tax-free money that is good to get a bucket of that started just to provide flexibility down the road for you. And that's money that you pay tax on when you know, it's money that's already been taxed. Once it gets into the Roth account, it grows tax-free. And so there is a strategy on where to place each of these assets if you have all three buckets, and so maybe sometimes that people only have two. But there is a way to reduce taxes over your lifetime significantly by just thinking a little bit about which type of account should own which types of investment assets. Let's talk about taxable assets. So taxable assets, we've got a few options of these, under that second row where it says type of asset. So our interest-paying investments, CDs, money market accounts, treasury bonds, those pay interest income, and that's going to be taxed as ordinary income. So it's taxed at our highest marginal rates. Dividend income, that comes from stocks that pay dividends, and equity securities are the type of assets. With equity securities, we are inside of a taxable account, we get the benefit of the lower capital gains rates. So even with the dividends, so qualified dividends, they are taxed at whatever capital gain rate, so 0, 15, or 20, depending on where you're at overall. And they're taxed at long-term capital gains rates when the gains are realized. And that's the same with capital gain income, so deferred until sale, which is nice, like in our stock example. You know, any stock that's not sold, but it's gone up in value, we're not paying tax on that increase in value until we realize the gains or sell the stocks. The equity securities also receive a step up in basis at death, which is really nice for assets that are held a long time and get passed down after death to heirs. And then real estate. Real estate has some additional tax benefits. This would be rental building, land, you know, VRBO, vacation homes, whatever it may be, apartments. They're taxed for capital gains purposes. They're taxed. There's a recapture component from the depreciation, but along the way you get that depreciation deduction, so they can provide some tax benefits along the way. Gains are still deferred until sale, and then if you want to exchange real estate for real estate, you can continue deferring the gains on the property sold through a 1031 exchange. So that's our first bucket. That's our taxable assets bucket. Bucket number 2, tax deferred. This is pension plans, profit sharing plans, 401k plans, traditional IRAs. It also includes deferred annuities. The income from these types of investments or accounts is, the growth is always tax deferred. They do require, the pension and IRA income does require a minimum distribution when you turn age 72 to 73, depending on what year you were born. And so that's a way that the government kind of forces the tax deferral to stop and forces you to pay tax on some of the growth. There's no step up at death, so any balance that transfers to an heir is going to be taxed at some point when that heir takes it out. And the income, like the withdrawals or the distributions you take from these types of accounts, they're always taxed at ordinary income, so no capital gains benefit for these types of accounts. Annuities work very similarly, deferred annuities specifically, and non-qualified annuities. There's qualified annuities would fit under the pension and IRA income bucket, but non-qualified annuities, that would mean after-tax money that you put into annuity. The growth is tax deferred. When you go to withdraw, the gain that you're withdrawing has to come out first, unless you annuitize it, and then it can come out in a ratio. But if you're just pulling some of it out, it's always the ordinary income gain first before your basis. There's no step up at death, and again, you're stuck with the ordinary income tax rates. All right, and then we have my favorite one, which is tax-free. There's kind of three areas of tax-free investment income. One is tax-exempt interest, so this would be from bonds issued by state and local governments. Those are federally tax-exempt, and if it's an in-state type program, like the bond was issued inside of Utah, if you're a Utah resident, that's state tax-exempt as well. There's also several states, not all of them, but there's a handful of states that provide reciprocity for Utah residents. So Texas, there's several others. But whenever you're buying these tax-exempt bonds, if you're buying these outside of Utah, you want to make sure it's a state that has reciprocity, because they'll also get the state tax benefit there. Roth IRAs. Roth IRAs are money that has been taxed already. Once it's inside the Roth IRA, it grows tax-free. So the benefits of this, other than the tax-free growth, are there's no required minimum distribution, and it's tax-free payout at death. So the more money you can get in Roth, the better. But you do want to kind of factor in what's your tax cost. So somebody who's working and contributing to a 401k plan, most 401k plans allow for a Roth contribution or a traditional contribution. And you kind of want to think through, what's my tax rate now versus what's my tax rate in the future. And if your tax rate's going to be higher in the future, that's where Roth becomes really attractive, because you're contributing money that you've paid tax on now at a low rate, with the assumption that your taxes are going to be higher in the future, and all that growth's tax-free. If it's the opposite of that, which is kind of the case for most working individuals, your income's usually higher while you're working, then the traditional 401k may be more valuable, because you're getting a tax break at a higher rate than you will be when you're in retirement. Of course, there's a lot of assumptions baked into that. We have to assume that tax rates are going to be the same, or kind of guess where we think they're going to go. With the way the government spends money recently, it's likely that we'll have to raise taxes in the future. So we're kind of in a lower tax regime right now, so Roth may be a more attractive option if you believe tax rates are going to come up later. But the point is, you should think about it and use these different buckets to your advantage. We have life insurance, and then really we want to make sure we're capitalizing on the step up in basis as much as possible. So with kind of that background, how do we do that? So one way is to try and match up your ordinary income assets with in your tax deferred structures. So when if you're doing your financial planning and trying to come up with your investment allocation, and it includes an allocation to bonds or to interest paying investments that are typically safer and not as high growth potential, the most tax efficient place to own those are inside of the tax deferred vehicles, or the traditional IRAs and annuities. So your stocks are actually better in the Roth or the taxable, because you'll get the tax-free growth inside of the Roth, or you'll get a step up in basis and capital gains rates for your stocks in the taxable account. We also want to capture that foreign tax credit as much as possible. So if your investment plan includes an allocation to foreign stocks, having those in the taxable account will free up that foreign tax credit. And then harvest losses as possible, and then having the bonds inside of your traditional IRA will reduce your future required minimum distribution, because over time we would expect bonds to not grow as much as stocks. Stocks will, they've grown more historically, and that's what we'd expect to continue going forward. All right, what about in the blackout period? So sometimes there's a blackout period when people stop working and maybe before they start taking Social Security or, they're, whatever it may be. This is an opportunity to look at your tax bracket, and once you stop working, your taxable income may be reduced significantly, and we don't want to waste those lower brackets. So, um, and by utilizing the lower brackets now in this or during this blackout phase, we can prevent bracket creep from happening down the road. So what I'm talking about here is when we sit down with somebody and look at their situation and kind of map out their lifetime of potential income, tax situation. If there's a point down the road where they're going to have major bracket creep, meaning they're going to jump brackets and going to have significant tax issues in the future, we want to get income or assets out of their traditional IRA and into a Roth IRA, so to speak. So we can convert traditional money to Roth, but we want to do it with a smart within the brackets that we plan out. And that can help reduce your future RMDs over time. So one strategy to think about, so what we do is we project your adjusted gross income and taxable income all the way out to the years when you'd start turning 72 and 73 when those required minimum distributions start. And that will give us an idea on if we should be taking some action now to prevent bracket creep in the future. And some goals you might think about setting. So if we can avoid paying the 3.8% net investment income tax, that's a good goal to try and stay under if possible. Now, there's sometimes, hopefully, if you're doing really well and there's no chance of getting under, then it's maybe looking at goal B, which would be let's avoid the 20% capital gain rate by keeping our taxable income under $517,000. That'd be for a married couple. So, all right. And then during the retirement phase, when you start taking money out of your investments and your savings, we want to fund our lifestyle first through mandatory required income. So that's Social Security, any pensions, and required minimum distributions that we have from IRAs. Second, you can look at your taxable income from your portfolio. So that'd be dividends, any interest, that kind of thing. And then third, you can generate additional required cash by rebalancing portfolio, and that's selling equities with high basis in up markets and then selling fixed income in down markets, fixed income or bonds. All right, that's all I had prepared for the tax update. So still don't see any questions. If you have questions, type those in the Q&A. I'm gonna leave with some optimistic kind of thoughts here. So optimism is the only realism, and if you listen to the news, pay attention at all, there's not a lot of good optimistic things being talked about there. And even when you talk to your friends and your neighbors and whoever, your family members, there can be a negative sentiment about where we're headed as a country, as a humanity. And I love this quote. On what principle is it that when we see nothing but improvement behind us, we are to expect nothing but deterioration before us? So I think it helps me put things into perspective. Over time, humanity finds a way, and sure, there's bad things that happen, and we have challenges and struggles, but overall, I think an optimistic approach on life is a much better one, and the reality is we've improved as time has gone on. And here's some of those examples. So even just 50 years ago, more than half the people on Earth were in extreme poverty, and the same percentage were illiterate. If you look at those numbers today, it's 10% and 15%. That's huge, huge improvements. And you'll never see this headline, but this is happening daily. Every 250,000 people every day escaped extreme poverty, and then 300,000 people get access to clean water for the first time. Really amazing when you think about it. And even just since 1900, it seems like a long ways away. It wasn't that long ago, but life expectancy's doubled. That brings on its own challenges, but it's just amazing that it's doubled that in that short of a time. Here's some other cool ones. So our world food production has more than doubled since the 1960s, while we haven't devoted any additional land to agriculture. So the land has remained the same. It's just that smart people have learned how to grow more food in the same amount of land. 5 people a second are being drawn up into the middle class. This third one's cool. So the smartphone that we send our middle schoolers uh, with to school with contains more computing power than even existed on the whole Earth in the 1950s. And then moving on, 50 years ago, it was inevitable that we were going to run out of oil. But after a half century of using oil and consuming hydrocarbons, the proven reserves are greater than they even were in 1970. And just this just shows the value and the progress of technology. We're able to get these hydrocarbons out of different, using different technology and fracking and all those things. And energy is going to be one of our big struggles down the road as a country and as humanity grows and progresses. But I'm optimistic that we can figure it out. And the disposable income, this bottom one's really cool. So just in the United States, disposable income per capita, adjusted for inflation's increased from 12,500 in the 60s to 64,000 today. So just huge progress being made. Still lots of challenges, but I would bet on America and humanity to figure out how to deal with the challenges. I would take that bet any day of the week. And that's all I had. So thank you for participating in our tax update webinar. If you have questions, reach out to us, reach out to your CPA. We're happy to help, and your wealth advisor. And if you ever want a second opinion on your investment strategy to give you some tips on how to make it more tax efficient, we're happy to provide that. We do a portfolio analysis that's complimentary. All we need is a statement from your investment account to kind of show you where you have some gaps and what you could improve on from a tax efficiency perspective. And we look at your investments as well. So no comments in the Q&A. I'll stick around for a few more minutes, and if anybody wants to, if anybody wants to type anything in there, go ahead, and if not, have a great day, and enjoy Valentine's, I guess, is probably the next holiday coming up. So thank you.